There is a lie at the heart of the stock market, a seductive and comforting lie that costs investors trillions of dollars over their lifetimes. It's the idea that a company's value to you, the shareholder, is measured by the cash it puts in your pocket. It's the siren song of the dividend check, the tangible proof that your investment is working. We are told to hunt for yield, to build an income portfolio, to find stocks that pay us for our loyalty. But what if this entire framework is a trap? What if the most powerful wealth-generating companies in history are the ones that pay you nothing at all? What if the real measure of your wealth isn't the dividend you receive, but the mountain of cash the company is earning and keeping on your behalf? This is the secret that separates the greatest investor of our time, Warren Buffett, from the 99% of market participants who are perpetually chasing their tails. He discovered a principle so profound, it reframed his entire approach to investing. It's a concept called look-through earnings, and it is the key to unlocking a universe of hidden wealth. It's the realization that when you buy a share of stock, you are not buying a lottery ticket that might pay you a quarterly prize. You are buying a fractional ownership of a real business. And as an owner, you are entitled to your share of 100% of the profits, not just the small slice the board of directors decides to mail to you. The costly mistake this prevents is catastrophic. It's the tragedy of selling a magnificent, world-changing company in its infancy simply because its dividend is small or non-existent, completely ignoring the fact that it is wisely and aggressively reinvesting every single dollar of profit to build an unassailable empire. It's selling Amazon in 2005 because it paid no dividend, while it was quietly building the cloud infrastructure that would one day rule the digital world. It's selling Apple in 2008 because its payout was trivial, while it was using its retained earnings to fund the development of the iPhone, the most profitable product in human history. The financial transformation that occurs when you grasp this concept is like switching from a black and white television to a full-color IMAX screen. You will finally learn to see your portfolio's true underlying earning power. You will gain the unshakable conviction to hold on to these wealth-compounding machines for decades, long before the broader market and the talking heads on television recognize their full, world-altering value. You will stop being a dividend chaser and become a business owner, and that is the final promise of intelligent investing. This is the story of how a $25 million box of chocolates taught Warren Buffett a $2 trillion lesson. The year was 1972. The year in America was thick with change and uncertainty. The Vietnam War raged on, the Watergate scandal was beginning to unravel the Nixon presidency, and the economy was suffering from a debilitating combination of stagnation and inflation. In the world of finance, the Nifty 50 bull market was in full swing, a period where investors believed that one could pay any price for the stock of a great growth company like Xerox, Polaroid, or IBM. It was a time of glamour stocks and speculative fervor. And in Omaha, Nebraska, a 41-year-old Warren Buffett, operating through a holding company called Blue Chip Stamps, was looking to make a deal. But he wasn't looking at technology or glamorous consumer brands. He was looking at candy. Specifically, See's Candies, a beloved, family-owned chocolate company based in California. For Buffett, this was a moment of profound internal conflict. He was a devout student of Benjamin Graham, the father of value investing. Graham's philosophy, which Buffett had absorbed down to his bone marrow, was what he would later call cigar butt investing. The idea was simple. You scour the market for discarded cigar butts, businesses that were so statistically cheap, so beaten down, that they had one good puff left in them. You weren't buying a great business. You were buying a terrible business at a price so low that a final liquidation or a small bounce back would give you a quick, reliable profit. You looked at balance sheets, at net tangible assets, at working capital. You cared about the numbers, not the narrative. And by the numbers, See's Candies was no cigar butt. The See family wanted $30 million for their business. At the time, See's had about $8 million in tangible assets, things like factories, inventory, and delivery trucks. The remaining $22 million of the asking price was for something that didn't appear on the balance sheet: the brand, the customer loyalty, the decades of happy memories associated with a box of See's chocolates. In the cold, hard calculus of Ben Graham's world, this was called goodwill, and it was a dirty word. It was ephemeral, unquantifiable, and to be avoided at all costs. Buffett's partner, Charlie Munger, was the one pushing for the deal. Munger, a brilliant lawyer and investor in his own right, had a different perspective. He was trying to nudge Buffett away from the quantitative purity of cigar butts and toward the qualitative reality of great businesses. Munger understood that some companies possessed an invisible asset, a durable competitive advantage, that allowed them to earn spectacular returns year after year. He saw this in See's. Buffett was deeply skeptical. Paying nearly 4 times the value of the physical assets for a candy company felt like a betrayal of his intellectual heritage. He and Munger negotiated, haggled, and finally got the price down to $25 million. Buffett, still feeling the sting of paying what he considered a premium price, almost walked away. In his own words, his Ben Graham-conditioned mind screamed, "No." But Munger's logic prevailed, and they closed the deal. It was the single largest acquisition they had ever made, and it would become the most important intellectual turning point of Buffett's entire career. What happened next wasn't an immediate explosion of growth. It was something far more subtle and profound. See's Candies was a mature business. It sold about 16 million pounds of chocolate a year, earning a respectable $2 million after tax. The magic of See's was not in its growth, but in its economics. It was a cash machine. Because customers were so loyal and the brand was so strong, especially around holidays like Christmas and Valentine's Day, See's could raise its prices by a little bit each year to offset inflation, and customers wouldn't flinch. They weren't just buying chocolate, they were buying tradition, quality, and nostalgia. This pricing power meant that profits grew steadily. But here was the truly crucial discovery. The business required almost no additional capital to function. They didn't need to build massive new factories or invest in expensive research and development. The brand did all the heavy lifting. So year after year, See's would generate millions of dollars in profit, and almost all of it was free cash that didn't need to be plowed back into the candy business itself. For Buffett, this was a revelation. With his old cigar butt companies, any profit they made usually had to be reinvested immediately into a lousy, low-return business just to stay afloat. It was like trying to fill a leaky bucket. But with See's, the bucket was solid gold. The $2 million in profit in 1972 became $4 million, then $13 million, then decades later, $80 million a year. And over the nearly 5 decades since that $25 million purchase, See's Candies has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, cash that Buffett could then take and reinvest elsewhere into other wonderful businesses like Coca-Cola or American Express. The initial $25 million investment was returned in just a few years, and then the candy company became a perpetual annuity, a gusher of cash that funded the growth of the entire Berkshire empire. This is where the concept of look-through earnings was truly forged. Buffett realized that as the owner of See's Candies, Berkshire's wealth wasn't just the small dividend See's might have paid to its parent company. Berkshire's wealth was increasing by 100% of See's profits every single year. He owned the whole thing. The profits that were retained inside See's weren't lost, they were still his. And because those profits were now sitting inside Berkshire Hathaway, he, as the master capital allocator, could direct them to their highest and best use. He could look through the corporate structure of See's Candies and see the underlying river of cash that was now flowing into his control. The lesson was seismic. He had paid a, quote, premium price for a business, but in doing so he had acquired an economic engine of such quality that the initial price soon became laughably irrelevant. He learned that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The $25 million spent on See's Candies taught him that the true value of a business isn't in its tangible assets, but in its ability to generate cash over time and, crucially, in the intelligence with which its retained earnings are deployed. It was the moment he graduated from being a quantitative scavenger to a qualitative business analyst. The See's Candies transaction was not just a financial masterstroke, it was a psychological breakthrough. To understand its significance, we must delve into the very wiring of the human brain and the cognitive biases that governed Buffett's early career, biases he had to consciously dismantle to reach the next level of wealth creation. The primary psychological principle at play was Buffett's struggle to overcome his deep-seated anchoring bias. Anchoring is our tendency to rely heavily on the first piece of information offered when making decisions. For Buffett, that anchor was the entire intellectual framework of Benjamin Graham's The Intelligent Investor. For years, his reality was defined by metrics like price-to-book value and net working capital. He was anchored to the idea that value meant statistical cheapness. He would find a company trading for $10 million, see that its physical assets could be sold off for $15 million, and buy it. The logic was inescapable, safe, and profitable. When See's Candies came along, it presented a jarring new piece of information. The tangible assets were only $8 million, but the price was $25 million. This violently contradicted his anchor. His brain, like any human brain, recoiled. The discomfort was real. He was being asked to value the invisible, the goodwill, the brand. To his Graham-trained mind, this was akin to financial heresy. He was anchored to the concrete, and Munger was asking him to pay for the abstract. This battle is one that every investor faces. We anchor to the price we first paid for a stock. We anchor to a stock's 52-week high or low. We anchor to a certain P/E ratio that we deem expensive. This cognitive shortcut saves us mental energy, but it also builds a prison around our thinking. Buffett's genius was in recognizing the prison and finding the key. The second related principle he was battling was what we can call cigar butt comfort. This is a manifestation of familiarity bias, our tendency to prefer what we know. Buffett knew how to find cigar butts. He had a system. It was repeatable, it was safe, and it had made him a millionaire many times over. Leaving this comfortable system to venture into the world of quality businesses at premium prices was a journey into the unknown. It required letting go of a proven strategy for one that was, for him, theoretical. He had to trade the comfort of the balance sheet for the uncertainty of predicting a company's future competitive strength. This is why so many investors cling to outdated strategies. The old dividend stock strategy their grandfather used feels comfortable and familiar, even if the math shows that a growth-oriented, no-dividend company offers a far superior path to wealth. Munger's role in this was crucial. He acted as a debiasing agent. He forced Buffett to confront the limitations of his own model. He didn't just say, "pay up for C's." He provided a new mental model, the idea of a franchise, a business with a durable competitive moat. He reframed the problem. The question was not, are we overpaying for the tangible assets? The question was, what is the present value of the future cash this indestructible franchise will produce? By changing the question, Munger helped Buffett lift his anchor and sail into new, more profitable waters. The psychological transformation was this. Buffett moved from a static view of value to a dynamic one. The cigar butt approach is static. You are assessing a company's value, as it is asterisk today, based on its liquidation value. The See's Candies approach is dynamic. You are assessing its value based on its ability to grow its earning power over the next several decades. This required a complete rewiring of his brain, forcing him to embrace forecasting, qualitative analysis, and the judgment of management, all things his mentor Graham had warned against as speculative and dangerous. Overcoming these biases is the true hidden lesson of the See's deal. It teaches us that our most deeply held financial beliefs, our anchors, might be the very things holding us back from exponential portfolio growth. True intelligent investing requires the humility to recognize when our old maps no longer describe the new territory and the courage to draw a new one. The profound lesson from See's Candies can be distilled into a powerful, practical mental model that any investor or entrepreneur can apply. We can call it the toll bridge blueprint. Imagine you have the opportunity to buy a single, unregulated toll bridge that connects a thriving city to its most vital suburb. Every car that crosses must pay you a fee. Your costs are minimal. Some basic maintenance, a few toll collectors. You have a monopoly, a moat. Your customers cannot easily go anywhere else. And every year, as the city grows and inflation rises, you can nudge the toll up by a few cents, and no one will stop paying. This business requires almost no new capital investment, yet it gushes cash day after day. This is what Buffett realized he was buying with See's Candies. He was buying a brand that acted as a toll bridge on the emotions of its customers. To apply this blueprint to your own stock analysis and business analysis, you need to follow a rigorous 4-step process. Step 1 is to identify the toll bridge itself. This is the company's durable competitive advantage, or what Buffett calls its moat. A moat is a structural feature of a business that protects it from competition. It can come in several forms. For See's, it was an intangible asset, its brand, built over decades. For a company like Coca-Cola, it's also brand. For Google, it's a network effect in search. For American Express, it's the trusted network between merchants and cardholders. For a railroad like BNSF, it's a massive, hard-to-replicate physical asset base. Your first task is to ask, what prevents a competitor from coming in tomorrow and offering the same product for 5 cents less and destroying this business? If you can't answer that question clearly and concisely, there is no toll bridge, and you should move on. Step 2 is to analyze the return on the bridge's construction cost, or in business terms, the return on tangible capital. A great toll bridge, like a great business, doesn't require constant, expensive upgrades. Remember, See's needed very little new capital to grow its profits. You must dive into the company's financial statements. Look at its return on equity, ROE, and, more importantly, its return on invested capital, ROIC. A truly great business can consistently generate returns of 15%, 20%, or even more on the net tangible assets it employs. A mediocre business struggles to earn more than its cost of capital, constantly needing to pour money back in just to tread water. You are looking for businesses that produce vast amounts of cash relative to the assets they need to operate. Step 3 is to assess the integrity and skill of the toll collector. This is the company's management team. Even the best toll bridge can be run into the ground by a dishonest or incompetent operator. You need to evaluate the CEO's capital allocation skills. What do they do with the river of cash the business generates? Do they reinvest it wisely in projects that earn high rates of return, as See's did by sending its cash to Buffett? Do they buy back shares when the stock is undervalued, effectively increasing your ownership stake in the business? Or do they squander it on foolish empire-building acquisitions that destroy shareholder value? You must read the CEO's annual letter to shareholders. Do they speak candidly about their mistakes? Do they have a clear, rational plan for deploying capital? A great business in the hands of a poor capital allocator will not create long-term wealth. Step 4 is the final calculation. Determine the true earnings of the toll bridge. This is where you move beyond reported GAAP earnings and calculate what Buffett calls owner earnings. This is roughly the company's net income, plus depreciation and amortization, which are non-cash charges, minus the average annual amount of capital expenditures the business needs to maintain its competitive position and unit volume. This figure gives you a much clearer picture of the cash that is truly available to the owners. This is your look-through earnings in its purest form. By following this 4-step blueprint, you stop being a stock picker and become a business analyst. You stop looking at charts and start looking for economic castles with unbreachable moats. You will find that very few companies in the world pass all 4 tests. But the ones that do are the engines of compounding wealth, the See's Candies of their generation, capable of delivering portfolio growth that can secure your financial freedom. To fully appreciate the wisdom of the Tollbridge blueprint, we must examine its opposite, the path of the 99%. This is the road most traveled by retail investors, and it is littered with financial wreckage. It is the path of the spreadsheet investor. The spreadsheet investor is obsessed with quantifiable metrics to the exclusion of all else. Their world is one of PE ratios, price-to-book values, and dividend yields. They believe that the entire story of a business can be captured in a few cells on a screen. If they were transported back to 1972 and presented with the See's Candies deal, their reaction would be swift and decisive. They would reject it out of hand. Their spreadsheet would flash red warning signs. The price-to-book ratio would be nearly 4-to-1. Unacceptable. The price-to-earnings ratio would likely be in the mid-teens, significantly higher than the dozens of cigar butt manufacturing or railroad stocks available in the market for a PE of 7 or 8. They would see the $30 million asking price and the $8 million intangible assets and conclude that they were being asked to pay $22 million for, essentially, air. The spreadsheet has no column for customer love. It has no cell for nostalgic tradition. It cannot quantify the joy of a family sharing a box of chocolates on Christmas Eve. And so, the spreadsheet investor, convinced of their own quantitative rigor, would pass on the deal. They would then take their capital and invest it in what their spreadsheet tells them is a cheaper company, perhaps a struggling textile mill in New England trading at a 50% discount to its liquidation value. They would congratulate themselves on their discipline on buying assets for 50 cents on the dollar. But they would be missing the most important part of the equation. The textile mill is a terrible business. It operates in a brutally competitive industry with no pricing power. Every dollar it earns has to be immediately reinvested into new looms and equipment, just to keep up with foreign competition. It earns a pathetic 3% return on its capital. It is a capital-intensive, low-return enterprise. It is a leaky bucket. Over the next 20 years, the textile mill might struggle along, producing meager profits and eventually going bankrupt, returning perhaps 70 cents on the dollar to our investor. Meanwhile, See's Candies, the expensive company, would have proceeded to generate hundreds of millions of dollars in cash, its earnings growing year after year, its brand strengthening, its moat widening. The initial $25 million investment would look like the bargain of a lifetime. The spreadsheet investor's fundamental error is mistaking precision for accuracy. A PE ratio is precise. It can be calculated to 2 decimal places, but it is not necessarily accurate in reflecting the true value of a business. The value of See's brand was not precise, but understanding its existence was far more accurate in predicting its future success. This path of the 99% leads directly to a portfolio of mediocre businesses. It's a collection of statistically cheap companies that appear attractive on a screen but lack any real long-term competitive advantage. These portfolios don't compound wealth, they stagnate. The investor spends all their time buying and selling these cigar butts, incurring transaction costs and taxes, all for a series of small, unsatisfying puffs of profit. They are perpetually stuck in first gear, while the owners of great businesses are accelerating down the open highway of long-term compounding. They have chosen the illusion of quantitative safety over the reality of qualitative strength, and it is a choice that costs them the chance at true financial freedom. The direct financial connection between the See's Candies principle and building wealth is one of the most powerful forces in capitalism, and it can be seen directly on the financial statements. The magic is in the conversion of retained earnings into market value. Let's quantify the impact. When Buffett and Munger bought See's for $25 million in 1972, it was earning about $2 million after taxes. Let's imagine 2 hypothetical scenarios for that $2 million in profit. Scenario A is the path of a typical, slow-growth company. It decides to pay out half of its earnings, $1 million, as a dividend to its owner, Berkshire Hathaway. The other $1 million is retained and reinvested back into the candy business. But because the business is already mature and not growing quickly, that $1 million of reinvestment only earns a modest 5% return. So the next year, it generates an extra $50,000 in profit. It's growth, but it's anemic. Now consider scenario B, the See's Candies reality. See's paid its profits up to its parent company, Berkshire. The key difference is that the capital allocator, Warren Buffett, could take that $2 million and reinvest it not at 5%, but at the much higher average rate of return Berkshire was able to achieve over the decades, say 15% or 20%. That $2 million in retained and redeployed earnings from See's wasn't just adding $100,000 to next year's profit, it was adding $400,000. This is the financial engine at the heart of compounding wealth. The market eventually recognizes this superior rate of return. The math works something like this. For a normal, average business that earns an average return on its capital, $1 of retained earnings might, over time, create roughly $1 of market value for the stock. But for an extraordinary business like See's, whose profits are being reinvested at exceptionally high rates, $1 of retained earnings can create $2, $3, or even $5 of market value. The company's stock price rises by a multiple of the profits it keeps. This is how massive capital gains are born. Let's look at the direct, staggering numbers. The initial investment was $25 million. That was the book value of Berkshire's investment. Over the subsequent decades, See's has produced over $2 billion in pre-tax earnings for Berkshire. None of this required significant additional capital investment from Berkshire. The original $25 million did all the work. That $2 billion is the look-through gain. It's the cash that flowed from the subsidiary to the parent, which Buffett then used to buy other toll bridge businesses like Coca-Cola, Geico, and BNSF Railway. The initial purchase of one wonderful business funded the acquisition of an entire empire of them. From a shareholder value perspective, this is the ultimate grand slam. An investor who only looked at See's as a standalone candy company would have completely missed the story. They would have seen a business with modest growth, but an investor who understood the look-through earnings principle would see something far more powerful. A cash cow that was fueling a larger, faster-growing enterprise. The financial advantage is therefore twofold. First, you own a business that is growing more valuable every year as it retains earnings and invests them at a high rate of return. This drives the stock price up, creating capital gains. Second, if that business is part of a larger, intelligently managed conglomerate like Berkshire, or even just a well-run standalone company, those retained earnings are deployed in a way that creates even more value. It's a virtuous cycle. The focus on look-through earnings forces you to connect the income statement, the source of profits, with the balance sheet, where retained earnings grow shareholder equity, and the strategic decisions of management, how those earnings are deployed. This holistic view is the secret to moving beyond simple stock picking and into the realm of intelligent investing, creating a tangible and massive financial advantage over those who are simply chasing the next dividend check. There is a powerful and deeply ingrained human desire for certainty. We want guarantees. We want the bird in the hand. And in the world of investing, the dividend is the ultimate bird in the hand. It's cash, deposited directly into your brokerage account. It feels real, safe, and productive. This psychological pull is so strong that it creates a massive market inefficiency known as the dividend illusion, and it's the primary reason why most investors get it so wrong. To understand this, let's travel back to the mid-1970s. Warren Buffett had made a substantial investment, one of his largest to date, in the Washington Post Company. On the surface, it looked like a terrible investment for an income seeker. The company's dividend yield was less than 1%. A typical dividend investor of that era would have scrolled right past it, looking instead for a utility stock paying a steady 5 or 6%. They would have seen the tiny dividend as a sign of weakness or stinginess. But Buffett saw a completely different picture. He wasn't focused on the dividend. He was focused on the business and its brilliant CEO, Katharine K. Graham. The Washington Post at the time was a dominant newspaper in a major city. It had a local media monopoly, a true toll bridge. It generated enormous amounts of cash. But instead of paying out that cash in large dividends, Kay Graham was doing something far more intelligent. She was using the profits to aggressively buy back the company's own stock. When a company buys back its own shares, it's like a reverse stock split. The number of slices in the pizza gets smaller, so each remaining slice becomes larger and more valuable. For a long-term shareholder like Buffett, every share repurchase meant that his proportional ownership of the Washington Post's media empire was increasing, without him having to lift a finger or invest another dollar. He saw that his personal share of the Post's massive, underlying look-through earnings was growing at a rapid pace year after year. The market, fixated on the paltry dividend, completely undervalued the stock. The dividend chaser saw a 1% yield. Buffett saw his ownership stake in a cash-gushing monopoly growing by 10% or 15% annually through a combination of business growth and share buybacks. He was getting richer every single day, even though he wasn't receiving a check. This is the essence of the dividend illusion. It's the failure to see that a dollar reinvested by a brilliant manager can be worth far more than a dollar paid out to a shareholder who might not have the same investment opportunities. Kay Graham could use the company's profits to buy back shares at a massive discount to their intrinsic value, generating a huge return for the remaining shareholders. The average shareholder, receiving that same dollar as a dividend, might have just spent it or reinvested it in a mediocre savings account earning a few percent. The capital was far more valuable inside the company. This anecdote reveals the costly mistake that millions of investors make. They sell a fantastic wealth-compounding machine simply because it doesn't mail them a large enough check, ignoring the invisible wealth being built by the profits the company wisely reinvests on their behalf. They choose the small, visible bird in the hand over the flock of much larger birds breeding in the bush. The dividend illusion is not just a matter of financial miscalculation, it's a trap laid by the deep-seated biases of human psychology. Our brains are not naturally wired to make optimal long-term financial decisions, and the allure of dividends plays directly into these cognitive flaws. The first and most powerful principle at play is mental accounting. Coined by Nobel laureate Richard Thaler, mental accounting is our tendency to place different values on money depending on its source or intended use. We create separate buckets in our minds. There's salary money, which we use for bills. There's windfall money from a bonus, which we might use for a vacation. And in investing, we create two very distinct buckets: dividends and capital gains. Dividends go into the income bucket. This money feels safe, earned, and stable, like a paycheck. We can mentally earmark it for living expenses in retirement. Capital gains, the money made from a stock's price appreciation, goes into the speculation bucket. This money feels ephemeral, risky, and unreal until we sell the stock. Because of this mental separation, many investors will cling to a high-dividend stock even as its price plummets, telling themselves, "At least I'm still getting my income." They fail to see that a 5% dividend is meaningless if the stock price falls by 20%. Total return is what matters, but our mental accounting system obscures this truth. The second cognitive bias is loss aversion. Psychologically, the pain of a loss is about twice as powerful as the pleasure of an equivalent gain. A dividend is a guaranteed gain. It's a small, certain positive event. A stock price, on the other hand, can go down. The potential for that price to fall triggers our loss aversion. Therefore, we irrationally prefer the certainty of a small dividend over the uncertainty of a potentially much larger capital gain. Because the latter also comes with the risk of a capital loss, we choose the small, guaranteed pleasure to avoid the potential for a large pain, even if the odds are heavily in favor of the capital gain. The market might be offering a 15% expected total return from a growth company, but we'll choose the 4% dividend from a stagnant company because it feels safer. This is our ancient, survival-oriented brain making decisions in a modern, complex environment where it is hopelessly outmatched. Furthermore, the regular, predictable nature of quarterly dividends plays into our preference for predictability. We are pattern-seeking creatures. A dividend that arrives every 90 days, like clockwork, satisfies our brain's craving for order and reliability. The lumpy, unpredictable nature of capital gains feels chaotic and dangerous in comparison. We will often sacrifice higher long-term returns for the comforting rhythm of a dividend schedule. When you combine these biases, mental accounting, loss aversion, and a preference for predictability, you get the perfect psychological storm. It creates an investor who is structurally biased toward dividend-paying stocks, often regardless of the underlying business fundamentals. They are not making a rational financial choice, they are making an emotional one. They are choosing comfort over wealth. Buffett's genius lies in his ability to completely override this faulty mental wiring. He doesn't have an income bucket and a capital gains bucket. He has one bucket: business value. His only question is whether the total value of his ownership stake is increasing at a satisfactory rate. By dissolving these artificial mental barriers, he is able to see the world with perfect financial clarity, a clarity that allows him to let his winners run for decades, compounding their look-through earnings into legendary fortunes. To break free from the dividend illusion, you need a practical mental model that forces you to think like a true business owner, not a passive income collector. This model is called the two pockets test, and it is a simple thought experiment that reveals the mathematical truth behind reinvestment versus payouts. Imagine you own 100% of a small private business. Let's say it's a successful local hardware store. This year, after all expenses and taxes, the business has generated $1 million in profit. This profit is now sitting in the company's bank account. As the sole owner, you face a critical decision. You have two pockets. Your left pocket is your personal bank account, and your right pocket is the company's bank account. You have two choices for that $1 million. Choice A is to take the $1 million out of the company's bank account, the right pocket, and put it into your personal bank account, the left pocket. This is a dividend. The money is now yours to spend or invest as you see fit. Choice B is to leave the $1 million in the company's bank account, the right pocket. This is a retained earning. The money still belongs to you. You own the whole company, after all, but it remains inside the business. Now here is the crucial question you must ask to make the decision. Where will that $1 million earn a higher rate of return? Let's say you know that your hardware store is a fantastic business. For every dollar you reinvest in it, perhaps to open a new location in a neighboring town or to expand your inventory of high-margin products, you can confidently earn a 20% annual return. If you leave the $1 million in the business, you can reasonably expect it to generate an additional $200,000 in profit for you next year. Now consider your other option. If you take the $1 million as a dividend and put it in your personal account, what can you do with it? After paying taxes on that dividend, you might be left with $800,000. Perhaps you can invest that in the S&P 500 and earn the historical average of about 10% a year, which would be $80,000. The choice is suddenly crystal clear. Leaving the money inside the business, where it can compound at 20%, is vastly superior to taking it out and personally investing it at 10%. Any rational business owner would choose to retain the earnings. The two pockets test is the blueprint for making this decision. Here is how you apply it to a publicly traded stock you own or are considering buying. Step 1. Calculate the company's return on equity, ROE. This metric tells you how effectively the company is generating profits from the money shareholders have invested. You can find this on any financial website. Look for a company that consistently earns a high ROE, preferably above 15%. This is the rate of return the company gets when it reinvests its profits. Step 2. Honestly assess your own personal opportunity cost. What is the rate of return you could realistically achieve if the company paid you that money as a dividend instead? For most retail investors, a reasonable assumption is the long-term return of a broad market index, like the S&P 500, which is around 10%. Step 3. Compare the two numbers. If the company's ROE is significantly higher than your personal opportunity cost, then every dollar the company retains on your behalf is being put to better use than if it were paid out to you. You should celebrate a low dividend because it means the management is intelligently reinvesting your capital at a high rate of return, making you richer, faster. If the company's ROE is lower than what you could earn yourself, then you should demand a dividend. In this case, the management is a poor steward of your capital, and you would be better off taking the cash and investing it elsewhere. This simple mental model shatters the dividend illusion. It replaces the emotional comfort of receiving a check with the cold, hard logic of capital allocation. It forces you to ask the single most important question: where will my money compound the fastest? And more often than not, in the case of a wonderful business, the answer is by leaving it in the far more capable hands of a management team that can reinvest it at a rate you could only dream of. The path of the 99% is paved with the allure of high dividend yields. It is the path of the dividend chaser, an investor archetype doomed to underperformance and, in many cases, catastrophic capital loss. The dividend chaser operates from a simple, flawed premise. The higher the dividend yield, the better the investment. Their stock screening process begins and ends with a single column, yield percent. They sort the entire market from high to low and start their research at the top of the list. They see a company paying an 8%, 10%, or even 12% dividend, and their eyes light up. They feel like they've discovered a secret, a money machine, that the rest of the market has somehow overlooked. They are walking directly into a well-known trap. Let's construct a typical scenario. The dividend chaser finds a company, we'll call it Stagnant Corp, in a mature, no-growth industry like traditional telecommunications or a struggling retail chain. Stagnant Corp stock has been falling for years, which has pushed its dividend yield up to a juicy 9%. The dividend chaser doesn't ask why the stock has been falling. They don't dig into the financials to see if the earnings can actually support this massive dividend. They are hypnotized by the yield. They buy the stock, dreaming of the steady income stream that will fund their retirement. What they have failed to understand is that the market is not stupid. A 9% yield in a world where government bonds pay 4% is a massive red flag. It is the market screaming that the dividend is in danger. Often these high-yield companies are what are known as dividend traps. The business is in decline, its earnings are shrinking. To maintain the high dividend and keep income-oriented investors from fleeing, the management starts paying out more in dividends than the company is actually earning in profit. They might be funding the dividend by taking on more debt or selling off assets. The balance sheet weakens. The business erodes from the inside out. This can go on for a few quarters, maybe even a year or two. The dividend chaser collects their checks and feels brilliant. They post on online forums about their passive income success. But eventually, reality hits. The company can no longer sustain the payout. They announce a dividend cut, perhaps by 50%, or they eliminate it entirely. On the day of the announcement, the stock price collapses. The dividend chasers who bought the stock solely for its yield rush for the exits all at once. The stock falls 30% or 40% in a single day. Our investor, who was so proud of collecting a 9% yield, has now suffered a 40% capital loss. They have lost more in a single day than they would have collected in dividends in over 4 years. This is the tragic and predictable fate of the dividend chaser. Their focus on the small, visible payout causes them to ignore the large and visible decay of the underlying business. They are picking up pennies in front of a steamroller. Their pursuit of income leads to the destruction of their capital, the exact opposite of their intention. This approach to asset allocation is fundamentally broken because it prioritizes the distribution of profits over the creation of profits. It leads to a portfolio filled with unhealthy, dying businesses that are returning capital to shareholders not as a sign of strength, but as a last gasp of life. It is the antithesis of the look-through earnings philosophy, which focuses on identifying healthy, growing businesses that are creating so much value that their best option is to retain capital and compound it. The dividend chaser achieves neither portfolio growth nor financial freedom. they achieve a portfolio of ticking time bombs. The financial chasm between the dividend-focused mindset and the look-through earnings mindset is not theoretical. It can be measured in millions of dollars over an investor's lifetime. Let's quantify the stark difference by modeling two distinct portfolios over a 20-year period. Our investor starts with $100,000. Portfolio A belongs to our dividend chaser. They meticulously construct a portfolio of high-yield stocks. After extensive screening, they achieve a blended portfolio dividend yield of 5%. Because these are mature, slow-growth companies, the underlying businesses and their earnings are only growing at about 2% per year. The investor reinvests every dividend they receive back into the portfolio. Portfolio B belongs to our look-through earnings investor. They follow the Buffett model, ignoring dividends entirely. They search for wonderful businesses with durable moats and intelligent management that can reinvest capital at high rates of return. Their portfolio has a blended dividend yield of 0%. They own the types of companies that the dividend chaser would ignore. However, because these companies are masterfully retaining and reinvesting their profits, their underlying look-through earnings are growing at an impressive 15% per year. The market, over time, recognizes this earnings growth, and the stock prices appreciate accordingly. Let's track the results. In year one, the dividend chaser in Portfolio A feels great. Their $100,000 generates $5,000 in dividends. They reinvest it. Their portfolio also grows by 2% in capital value. Their portfolio value at the end of the year is $107,100. The look-through investor in Portfolio B receives nothing in dividends. Their portfolio, however, grows by 15% in value. Their portfolio value at the end of the year is $115,000, a solid lead but not yet life-changing. Now let's let the magic of compounding do its work. We fast-forward 10 years. The dividend chaser's portfolio, with dividends reinvested, has grown from $100,000 to approximately $195,000. A respectable result, nearly doubling their money. They have successfully beaten inflation and feel secure. The look-through investor's portfolio, however, has compounded at 15% annually for a decade. Their initial $100,000 is now worth over $404,000. They have more than twice the wealth of the dividend chaser. The gap is becoming a gulf. Now let's go to the end of the full 20-year period. The dividend chaser in Portfolio A, diligently reinvesting their 5% dividends in their 2% growth companies, has seen their initial investment grow to approximately $380,000. They have nearly quadrupled their money and likely feel that their strategy has been a success. But now we look at Portfolio B, the look-through investor who received not a single dollar in dividends for 2 decades, has allowed their capital to compound at 15% per year. Their initial $100,000 has exploded into over $1,636,000. This is not a small difference. It is a life-altering chasm. The look-through investor has more than 4 times the wealth of the dividend chaser. They have achieved true financial freedom, while the dividend chaser has merely achieved a modest nest egg. This direct financial connection illustrates the raw power of earnings growth over dividend distribution. The look-through investor understood that the real money is made not from the sliver of profits a company pays out, but from the mountain of profits it retains and compounds internally. The stock price is ultimately a slave to earnings. By focusing on the growth of the underlying look-through earnings, they harnessed one of the most powerful forces in the universe: compound interest. The dividend chaser, by focusing on yield, chose a linear path in an exponential world, a decision that, quantified over 2 decades, cost them over $1.2 million. The ultimate expression of the look-through earnings principle, the grand cathedral built upon its foundation, is Berkshire Hathaway itself. The story of Berkshire is not just an anecdote. It is the definitive, multi-decade case study in the power of compounding retained earnings. And it has never, not once in over 50 years of Warren Buffett's leadership, paid a dividend to its shareholders. The story begins in the mid-1960s. Berkshire Hathaway was a failing New England textile mill, a classic cigar butt investment that Buffett had taken control of. The business was terrible. It was hemorrhaging cash in a dying industry. Buffett quickly realized that any profits the textile business did manage to generate had to be plowed right back into new equipment just to remain competitive, earning a pitiful return. It was a capital-intensive nightmare, but in 1967, Buffett made a pivotal move. He used the meager cash flow from the textile operations to buy something completely different, National Indemnity Company, an Omaha-based insurance firm. And with that purchase, he acquired the magic ingredient that would fuel the Berkshire empire, insurance float. Insurance companies collect premiums from customers up front and only pay out claims later. In the interim, that pool of money, the float, can be invested for the insurance company's benefit. Buffett realized that this float was a massive, interest-free loan. He now had a permanent and growing source of capital that he could invest as he saw fit. This was the birth of the compounding engine. Here is how it worked. National Indemnity and later Geico would generate float. Buffett, the master capital allocator, would take this float and the retained earnings from these insurance businesses and buy other businesses. He bought See's Candies. He bought the Buffalo News. He bought the Nebraska Furniture Mart. These businesses, in turn, produced their own profits. Instead of paying those profits out as dividends to Berkshire shareholders, those profits were retained at the parent company level. This ever-growing mountain of retained earnings was then combined with the ever-growing insurance float and used to buy even more and larger businesses and stocks: Coca-Cola, American Express, Apple, BNSF Railway. It became a perpetual motion machine of wealth creation. Each component of the empire produced cash, which was sent to the central hub in Omaha, where Buffett and Munger would redeploy it into the next most attractive opportunity. $1 earned by See's Candies in California in 1985 could be used to buy shares of the Washington Post in 1986. Profits from Geico in 2005 could be used to help acquire a massive railroad in 2009. A shareholder of Berkshire Hathaway in, say, 1980 received no dividend check, but their ownership stake was not just in a textile mill anymore. They now owned a piece of a world-class insurance operation, a beloved candy company, a dominant local newspaper, and much more. Their look-through earnings were the sum of the profits from all of these disparate businesses. And because Buffett was reinvesting 100% of these profits at an average rate of return far exceeding 20% for decades, the intrinsic value of a single share of Berkshire Hathaway was compounding at a breathtaking pace. This is the compounding engine in its most magnificent form. It's a system where capital is continuously recycled from low-return or mature businesses to high-return and growing ones, all within a single corporate structure, all without ever paying out a dividend and incurring the tax consequences that come with it. The shareholders' wealth grows not because they are getting a quarterly check, but because the pie itself is getting exponentially larger every single year. The story of Berkshire is the ultimate proof that the true measure of an investment is not what it pays you, but what it earns for you. To understand why so few investors can successfully emulate the Berkshire model, even when the logic is so clear, we must once again turn to the peculiar wiring of the human brain. The power of compounding is mathematically undeniable, but it is psychologically counterintuitive. The primary cognitive bias that stands in our way is known as hyperbolic discounting. This is our brain's tendency to have a stronger preference for smaller, immediate rewards over larger, later rewards. The preference for the immediate reward is so strong that we discount the value of the future reward, often to an irrational degree. Think of the classic marshmallow test with children. The child who can wait 15 minutes to get 2 marshmallows instead of taking 1 marshmallow now is demonstrating the ability to overcome hyperbolic discounting. In the world of investing, a quarterly dividend is the marshmallow you can have right now. It's a small, tangible, immediate reward. The massive capital gain that comes from 30 years of uninterrupted compounding is the promise of 2, or in this case, 100 marshmallows, far in the future. Our brains are hardwired from millennia of evolution to prioritize immediate survival and gratification. Our ancestors didn't need to plan for a retirement 30 years away. They needed to find their next meal today. This deep-seated instinct makes us systematically undervalue the power of long-term, exponential growth. A 15% annual growth rate sounds abstract. A $500 dividend check that arrives on Tuesday feels real. We discount the enormous future value of the growth in favor of the small present value of the dividend. This is why people take out payday loans at exorbitant interest rates or fail to save adequately for retirement. They are making a trade between the present and the future, and the present almost always wins. Buffett's mind operates on a different timescale. He is not thinking about next quarter's dividend. He is playing a multi-decade game of chess. He is perfectly willing to forego a small reward today for a kingdom tomorrow. He has trained himself to fight against the pull of hyperbolic discounting and to fully rationally appreciate the explosive power of a high growth rate sustained over a very long period. This is a psychological superpower. It is the ability to truly internalize the non-linear nature of compound interest. Most people think linearly. They think that if you grow at 10% a year for 30 years, you'll have 300% more money. They fail to grasp that the growth is on top of the growth, leading to a result that is over 700% larger. Because we cannot intuitively feel this exponential curve, we don't value it properly. We don't have the patience to see it through. We see our no-dividend growth stock go up 15% one year and down 10% the next, and the volatility and lack of immediate reward make us anxious. We sell it and buy the safe 4% dividend utility stock, grabbing our one marshmallow now, and in doing so, we forfeit a lifetime supply of marshmallows later. Overcoming hyperbolic discounting is perhaps the single greatest psychological challenge for any long-term investor. It requires patience, discipline, and a deep, faith-like belief in the mathematics of compounding, even when the day-to-day market movements provide no immediate gratification. The lesson from Berkshire Hathaway can be translated into a practical mental model for evaluating any potential investment: the reinvestment moat. We are all familiar with Buffett's idea of a competitive moat, the durable advantage that protects a business from competitors. But the reinvestment moat is a more advanced concept. It's not just about the quality of the core business. It's about the company's ability to intelligently reinvest the profits from that business at high rates of return. A great company with no place to reinvest its cash is like a brilliant general with no wars to fight. Their talent is wasted. The reinvestment moat blueprint consists of 3 critical steps of analysis. Step 1 is to identify the company's return on invested capital, ROIC. This is arguably the most important single metric in all of finance. ROIC measures how much profit a company generates for every dollar of capital that has been invested in the business, both from shareholders and lenders. It is the purest measure of a company's profitability and capital efficiency. You are looking for companies that consistently generate a high ROIC, ideally above 15%. This number tells you the fundamental power of the company's compounding engine. A high ROIC means that every dollar of retained earnings is being transformed into a significant amount of new profit. Step 2 is to assess the size of the company's reinvestment runway. This is a qualitative judgment. The question is, how much capital can this business profitably reinvest? A corner coffee shop might be a great business that earns a 50% ROIC, but its runway is short. It can only reinvest enough capital to open a few more stores before it saturates its local market. A software company with a globally scalable product, on the other hand, might have a massive runway. It can reinvest billions of dollars in sales, marketing, and R&D to capture a global market, all while maintaining a high ROIC. You are looking for businesses that have both a high return on capital and times a long runway for reinvestment. This combination is the holy grail of compounding wealth. Think of early-day Amazon reinvesting every dollar of profit from its bookstore into new categories and then into Amazon Web Services. That was a company with a near-infinite reinvestment runway. Step 3 is to rigorously evaluate management's track record on capital allocation. This is where you separate the good businesses from the great investments. A company might have a high ROIC and a long runway, but if the CEO is a poor capital allocator, the shareholder value will be squandered. You must act like an investigative journalist. Read the last 5 years of shareholder letters. How does the CEO talk about deploying capital? Do they have a clear and rational framework? Then, check their work. Look at their history of acquisitions. Did they overpay? Did the acquisitions actually add value? Look at their history of share buybacks. Did they buy back stock when it was cheap? Or did they buy it back at the top of the market to prop up the stock price? A management team that is skilled at capital allocation is like a master chef with the finest ingredients. They will create a masterpiece. A poor capital allocator will take those same ingredients and burn the meal. By applying the 3 steps of the reinvestment moat blueprint, high ROIC, a long runway, and a skilled capital allocator, you move to the highest level of business analysis. You are no longer just asking, is this a good company? You are asking the far more important question for long-term investing. Is this a good compounder of my capital? Finding a company that excels in all 3 areas is rare, but when you do, you have found a potential multi-decade wealth-generating machine. To truly grasp the genius of the reinvestment moat, we must examine its antithesis, a common and destructive path followed by many investors, especially during bull markets. This is the path of the growth at any price investor. This investor is the mirror image of the dividend chaser. While the dividend chaser is obsessed with payouts, the growth at any price investor is obsessed with revenue growth. They see a company whose sales are increasing by 50% or 100% a year and they become infatuated. They don't stop to ask the crucial questions about profitability or return on investment. They are buying the story, not the business. They mistake activity for progress. The dot-com bubble of the late 1990s was the golden age of the growth at any price investor. Companies like Webvan or Pets.com were lauded as the future. Their revenues were exploding as they spent billions of dollars of investor capital to acquire customers. A growth at any price investor would have looked at these companies and seen only the spectacular top-line growth. They would have seen them reinvesting every dollar they had, but they would have failed to apply the reinvestment moat blueprint. If they had checked Step 1, return on invested capital, they would have seen that the ROIC was not just low, it was massively negative. These companies weren't reinvesting profits, they were incinerating capital. For every dollar of capital they invested, they were generating only a few cents of revenue and massive losses. There was no compounding engine. There was a wealth furnace. If they had assessed Step 2, the reinvestment runway, they might have thought it was huge. But it wasn't a profitable, not a reinvestment runway. You can always grow revenues if you're willing to sell a dollar bill for 80 cents. The ability to spend money is not a skill. The ability to invest money wisely is. These companies had a runway that led straight off a cliff. And if they had evaluated Step 3, management's capital allocation, they would have seen a team focused on a single metric, getting big fast. There was no discipline, no focus on building a sustainable, profitable business model. The strategy was to spend, 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 in the hopes that they could capture a market and then, somehow, magically, figure out how to make money later. The growth at any price investor buys into this narrative. They see the rising stock price, fueled by hype and speculation, and their fear of missing out overrides any rational analysis. They buy near the top, right before the cash runs out and the market comes to its senses. Then, the collapse comes. The company goes bankrupt, and their investment goes to zero. This is the crucial distinction that separates intelligent investing from speculation. Reinvestment of capital is only a good thing if that capital is invested at a high rate of return. Reinvestment at a low or negative rate of return destroys value. The retail investor who confuses the two is destined for failure. They see a company spending money on marketing and R&D and assume it's the same as what Amazon or Berkshire does. They fail to do the hard work of calculating the return on that spending. They are drawn to the exciting story of disruption and growth, and they ignore the boring but essential details of business economics. This leads to a portfolio of story stocks, companies with great narratives but terrible financials, and it is a path that almost always ends in tears. The financial mechanics of the compounding engine are elegant and devastatingly powerful. The entire process hinges on one simple line item on the balance sheet: shareholders' equity. This is the direct, quantifiable link between a company's day-to-day profits and the long-term growth of a shareholder's wealth. Let's walk through the transformation. Imagine a well-run company. Compounder Inc. starts the year with $1 million in shareholders' equity on its balance sheet. Shareholders' equity is essentially the net worth of the company, its assets minus its liabilities. Now, during the year, Compounder Inc. has a great year and produces $200,000 in net income. This is its profit. The company's management, being skilled capital allocators, decides to pay no dividend. They choose to retain 100% of that profit. That $200,000 of retained earnings is added directly to the shareholders' equity line on the balance sheet. So at the end of the year, the company's shareholders' equity, its book value, is now $1.2 million. The company is demonstrably, quantifiably richer by $200,000, and so are its owners. But here is where the magic happens. Compounder Inc. has a proven ability to generate a 20% return on its equity, its profit of $200,000 divided by its starting equity of $1 million. The market knows this. Investors recognize that this is a superior business. Because the company has this high return on equity, the market will value the stock at a premium to its book value. For a business of this quality, it might trade at, for example, 3 times its book value. So, at the start of the year, with a book value of $1 million, the company's total market capitalization, its stock market value, was $3 million. But at the end of the year, its book value has grown to $1.2 million. The market, applying that same 3 times multiple, will now value the company at $3.6 million. Look at what just happened. The company retained $200,000 of earnings, but the market value of the company increased by $600,000. $1 of retained earnings created $3 of market value. This is the nonlinear creation of wealth that is at the heart of long-term investing. It's the powerful synergy between a profitable business and an appreciative market. Now contrast this with a company that pays out that $200,000 as a dividend. That money leaves the company, it does not get added to shareholders' equity. The book value of the company remains stagnant at $1 million. The shareholder gets a $200,000 check before taxes, and the market value of the company stays at $3 million. In this scenario, $1 of earnings creates just $1 of value for the shareholder. By retaining the earnings, the company created 3 times as much wealth. This is the core mathematical advantage. By focusing on look-through earnings, you are aligning yourself with this powerful value creation mechanism. You understand that your wealth is not just the dividend check, it's the annual increase in the shareholders' equity of the businesses you own, amplified by the market's valuation of those growing earnings. This is how small sums of money, invested in the right kind of businesses that intelligently retain their profits, can compound into fortunes. It is the direct financial path from retained earnings on a balance sheet to staggering capital gains in your brokerage account. To truly unlock the power of look-through earnings, you must undergo a fundamental shift in identity. You must stop thinking of yourself as someone who buys and sells stocks and start thinking of yourself as a part owner of a handful of businesses. You must evolve from a trader to an owner. This owner's mindset is the philosophical bedrock of the entire Buffett approach. There is no story that illustrates this more perfectly than Buffett's acquisition of the Nebraska Furniture Mart in 1983. This was not a stock purchase. It was the purchase of an entire business, a massive, sprawling furniture store in Omaha, founded by a tiny, indomitable Russian immigrant named Rose Blumkin, known to all as Mrs. B. Mrs. B had built the mart from a tiny pawn shop into a retail behemoth that did hundreds of millions of dollars in sales, all based on her simple motto, sell cheap and tell the truth. Buffett had watched her business for decades. He admired her tenacity, her business acumen, and her absolute dedication to the customer. One day, he went to see the then 89-year-old Mrs. B and told her he wanted to buy her company. The negotiation was legendary in its simplicity. Buffett asked her for a price. She gave him one. He said yes. The deal, for approximately $60 million, was written on a single page of paper. Buffett did not conduct any due diligence in the traditional sense. He didn't send in an army of auditors to check the books. He didn't even ask for audited financials. His reasoning was simple and profound. He told Mrs. B, "We will not have a single person check your figures. You tell us what the company is worth, and we'll take your word for it." Why? Because his decision was not based on the numbers in a ledger. It was based on his decades-long assessment of the character of the owner and the fundamental strength of the business she had built. He knew Mrs. B was fiercely honest, and he knew she had created a business with a powerful, sustainable moat based on low prices and massive selection. He was buying the business, not just its financial statements. He was becoming a partner with Mrs. B. This story is the epitome of the owner's mindset. It's the understanding that when you buy a share of Coca-Cola, you are not buying a ticker symbol, KO. You are buying a fractional ownership of a global beverage empire. You own a piece of the secret formula, the bottling plants, the distribution trucks, the brand. The daily fluctuations of the stock price are just the manic depressive mood swings of your other, less informed partners. As a true owner, you should ignore them. Your focus should be on the long-term health and profitability of the business itself. Is it selling more Coke? Are its profit margins healthy? Is management making smart decisions for the future? If the answers are yes, then the short-term stock price is irrelevant noise. This mindset changes everything. It changes how you react to a market crash. A trader sees a crash and panics, selling everything. An owner sees a crash and rejoices, because it means they can buy more of their wonderful business at a cheaper price from their panicked partners. It changes how you read an annual report. A trader skims for the quarterly earnings per share number. An owner reads the CEO's letter carefully, trying to understand the strategic direction of the business they co-own. This shift is the ultimate antidote to the volatility and emotion that destroys most investors. By anchoring your identity as a business owner, you liberate yourself from the tyranny of the ticker. The failure to adopt the owner's mindset is what locks 99% of market participants into a cycle of underperformance. This failure is driven by a toxic cocktail of psychological biases. The primary culprit is the combination of the Dunning-Kruger effect and herd mentality. The Dunning-Kruger effect is a cognitive bias, whereby people with low ability at a task overestimate their ability. In investing, this manifests as the novice retail investor who, after a few lucky trades, believes they have cracked the code of the market. They have low competence but high confidence. This overconfidence leads them to believe they can outsmart the collective wisdom of the market by actively trading in and out of stocks. They believe they can predict short-term price movements. Then, herd mentality kicks in. This is our deep-seated instinct to follow the actions of a larger group, assuming they know something we don't. When the market is soaring, the overconfident novice sees everyone else getting rich and jumps in, buying high because the herd is buying. They are driven by greed and the fear of missing out. When the market panics, they see everyone else selling and rush to sell as well, locking in their losses. They are driven by fear. This combination is absolutely lethal to long-term wealth. The owner's mindset acts as a powerful vaccine against both of these biases. By viewing yourself as a business owner, you are less susceptible to the Dunning-Kruger effect because your focus shifts from predicting prices to understanding businesses. You quickly realize how much you don't know about a particular industry or company, which fosters a sense of humility. This humility prevents you from making rash, overconfident trading decisions. The owner's mindset also shatters the power of the herd. If you are a part owner of a fantastic local pizza parlor that is making more money every year, would you suddenly decide to sell your stake just because the owners of the laundromat and the bookstore down the street are panicking about the economy? Of course not. You would look at your own business, see that it is still thriving, and perhaps even offer to buy out your nervous partners at a discount. By focusing on the fundamentals of the specific business you own, you insulate yourself from the irrational, contagious emotions of the broader market. You are no longer part of the herd. You are a shepherd, calmly tending to your flock, while the other animals stampede senselessly. The investor who fails to make this mental shift is doomed to be whipsawed by the market's emotions, forever buying high in times of euphoria and selling low in times of despair. They have abdicated their role as a rational business analyst and have become a purely reactive creature, a leaf blown about in the wind of market sentiment. Adopting the owner's mindset is the only path to breaking this destructive cycle. The practical application of the owner's mindset can be crystallized into a powerful mental model, the private buyer test. Before you buy a single share of a publicly traded company, you must perform this crucial thought experiment. Ask yourself this simple question. If I had the money, and if the entire company were for sale at its current total market capitalization, would I buy the whole thing? This question forces a profound shift in perspective. You are no longer thinking about buying 100 shares of stock. You are contemplating buying a multi-billion-dollar enterprise. To answer this question honestly, you cannot rely on a stock chart or a single financial ratio. You must think like an entrepreneur or a private equity firm making a major acquisition. The test involves 4 rigorous steps. Step 1. You must understand the entire business model. How does this company actually make money? Who are its customers? What is its value proposition? You need to be able to explain the business to a 10-year-old in a few simple sentences. If you can't, you have no business owning it. Step 2. You must evaluate the long-term prospects of the industry in which it operates. Is this a growing industry, or is it in terminal decline? What are the major technological or societal trends that could affect it over the next 10 or 20 years? Buying the best horse and buggy manufacturer in 1910 was still a terrible investment. You must ensure you are not buying a business on the wrong side of history. Step 3. You must judge the quality and integrity of the management team. These are the people you would be hiring to run your multi-billion-dollar company. Would you trust them with your entire net worth? Read their shareholder letters. Listen to their conference calls. Do they seem like rational, honest, long-term oriented owner-operators? Or do they sound like promotional hype artists focused on the next quarter? As Buffett says, you should look for managers with intelligence, energy, and integrity. If they lack the last one, the first 2 will kill you. Step 4. You must determine a reasonable price for the whole enterprise. Based on its future earning power, what is a sensible valuation for this business? This forces you to think about intrinsic value, not just the current stock price. Is the current market capitalization a bargain, fair, or outrageously expensive compared to the cash you can expect the business to generate for you over its lifetime? Only after you have gone through these 4 steps, and you can honestly answer yes to the core question, would I buy the entire company? Only then should you proceed to buy a small piece of it. The private buyer test acts as a powerful filter. It will immediately eliminate 99% of the stocks that come across your screen. It forces you to ignore the noise and focus on what truly matters: business quality and valuation. It is the ultimate practical exercise in the owner's mindset, transforming you from a passive speculator into a disciplined, long-term business owner. The most overlooked but financially devastating consequence of abandoning the owner's mindset is the silent erosion of wealth through frictional costs and taxes. The direct financial connection is stark and unavoidable. The person who thinks like a trader, the stock renter, is constantly buying and selling. Each transaction incurs a cost. There might be a commission fee. There is always the bid-ask spread, the small difference between the price you can buy a stock for and the price you can sell it for, which acts as a small tax on every trade. These costs seem tiny on an individual basis, but for an active trader, they accumulate over a year into a significant drag on performance. But the true killer is taxes. Let's imagine two investors, both of whom are skilled enough to generate a 20% pre-tax return in a given year. Investor A is a stock renter. They achieve their 20% return by actively trading, buying a stock in January, and selling it in November for a profit. Because they held the stock for less than a year, this profit is classified as a short-term capital gain. In the United States, short-term capital gains are taxed at your ordinary income tax rate, which for a successful individual could be as high as 37%. Investor B is a business owner. They achieve their 20% return because the wonderful business they own has appreciated in value. But they don't sell. They continue to hold the stock. Their 20% gain is an unrealized capital gain, and the tax on an unrealized capital gain is zero. Let's quantify this. Both start with $100,000 and earn a $20,000 profit. Investor A, the trader, immediately owes the government 37% of their profit, which is $7,400. Their net gain is only $12,600. Their after-tax return is 12.6%. Investor B, the owner, owes nothing. Their entire $20,000 gain remains invested in their account, ready to compound the following year. Their after-tax return is 20%. The business owner's strategy is nearly 60% more effective than the stock renter's, simply due to the impact of taxes. Now, let this play out over a 30-year career. The difference is not just thousands of dollars, it is millions. The business owner's portfolio, by deferring taxes for decades, is able to grow on a much larger capital base. The government effectively becomes a silent, non-interest-paying partner in their wealth creation journey. The stock renter, by contrast, is giving a huge chunk of their profits to the government every single year, crippling their ability to compound. The owner's mindset, which naturally leads to a low turnover, buy and hold forever approach, is therefore not just a philosophical preference. It is a profound and deliberate wealth management strategy. It is the most efficient way to build a portfolio because it minimizes the two great destroyers of long-term returns: unnecessary costs and avoidable taxes. By simply choosing to be an owner instead of a renter, you give yourself a massive built-in financial advantage that almost guarantees superior long-term results. The culmination of this entire philosophy is its application not to a single stock but to an entire portfolio. The goal is to build your own personal Berkshire, a concentrated collection of wonderful businesses whose look-through earnings will compound over a lifetime. The masterclass in this approach occurred early in Buffett's career with his enormous company-defining bet on American Express. The year was 1963. American Express was a blue-chip, universally trusted company. Its primary businesses were its travelers' checks and charge cards, but it had a lesser-known division that made loans to businesses, using their inventory as collateral. One of its clients was the Allied Crude Vegetable Oil Company, run by a man named Tino DeAngelis. DeAngelis was a fraudster. He had discovered that he could borrow massive amounts of money by claiming to have huge storage tanks full of valuable salad oil. In reality, the tanks were mostly filled with water, with only a thin layer of oil on top to fool the inspectors. When the fraud was discovered, Allied Crude went bankrupt, and its creditors, including American Express, were on the hook for massive losses. Losses so large that they threatened to wipe out the entire net worth of American Express. The market panicked. The story was everywhere. Wall Street assumed American Express was insolvent. The stock, which had been trading at over $60, collapsed to $35. This is where Buffett, the business owner, went to work. He didn't just read the headlines. He ignored the readily available, terrifying narrative. Instead, he did the hard, on-the-ground research to find the disconfirming evidence. He knew the market was panicking about the salad oil scandal, but his real question was, has this scandal damaged the true, underlying earnings power of the core business, the traveler's checks and credit cards? To find out, he went to restaurants in Omaha. He went to banks. He talked to travel agents. He would stand at a cashier's counter and observe. Did people stop using their Amex cards? Did businesses stop accepting them? Were people still buying the traveler's checks? The answer he found was a resounding no. The fundamental behavior of the customers was unchanged. The brand's trust where it mattered was intact. The salad oil division was a separate, isolated problem. He then dug into the numbers. He calculated the company's true, ongoing look-through earnings power from its core, profitable businesses. He then calculated the absolute maximum possible loss from the salad oil fraud. He discovered that the earnings power was so immense that it could easily absorb the losses and recover within a couple of years. The market was pricing the company for bankruptcy, but the reality was that it was just a temporary, albeit large, flesh wound to an otherwise indestructible financial franchise. Convinced by his analysis, Buffett acted with incredible conviction. He invested 40% of his entire investment partnership's capital into American Express stock. It was a massive, concentrated bet. Over the next few years, as the market realized the company was not going bankrupt and its core earnings continued to grow, the stock soared, making a fortune for Buffett and his partners. This is the ultimate execution of the look-through portfolio philosophy. It's about ignoring the market's manic narrative, doing the deep work to understand the true, sustainable earning power of a handful of businesses, and when you find a massive discrepancy between price and value, betting big. The American Express salad oil scandal is a perfect illustration of the psychological warfare an investor must wage against their own mind to achieve superior returns. The average investor in 1963 was completely overwhelmed by two powerful cognitive biases: the availability heuristic and confirmation bias. The availability heuristic is a mental shortcut that relies on immediate examples that come to a given person's mind when evaluating a specific topic. The news about the Allied crude fraud was everywhere. It was dramatic, it was scary, and it was easy to recall. The story of American Express is going bankrupt was readily available and mentally loud. The much quieter, more complex story of the ongoing profitability of the traveler's check division was not readily available. It required effort to uncover. The average investor's brain, taking the path of least resistance, latched onto the available, dramatic narrative and sold the stock. Once this negative narrative was established, confirmation bias took over. This is our tendency to search for, interpret, favor, and recall information in a way that confirms or supports our pre-existing beliefs. An investor who thought Amex was in trouble would then actively seek out news stories and analyst reports that confirmed this view. They would read headlines about potential lawsuits and further write-downs, reinforcing their initial fear. Each new piece of negative information would strengthen their conviction that they were right to sell. They would systematically ignore or discredit any information to the contrary, such as reports about the continued strength of the charge card business. Buffett's genius was to consciously and deliberately invert this entire process. He actively fought the availability heuristic. He recognized that the loudest story is not always the truest story. He deliberately ignored the easily available narrative and went in search of the hard-to-find data points. He did this by literally walking the streets and observing consumer behavior, a form of information gathering that was not available to the Wall Street analyst sitting in his office in New York. He was seeking out unique, disconfirming evidence. In doing so, he was also waging war on confirmation bias. He didn't start with a conclusion and look for facts to support it. He started with a question: is the core franchise impaired? And then sought out all information, both positive and negative, that could help him answer it. This scientific, dispassionate approach to fact-finding is exceedingly rare. It requires a level of emotional detachment and intellectual honesty that few possess. The lesson for building a look-through portfolio is profound. You must become a skeptic of popular narratives. You must question the information that is most easily available. And you must actively search for evidence that disproves your own initial assumptions. This is the psychological discipline required to buy a wonderful business when everyone else is selling it in a panic. which is precisely the moment when the greatest fortunes are made. Now it's time to translate this powerful theory into a direct, practical application for your own investments. You can do this with a simple but profoundly illuminating tool: the look-through earnings calculator. This is not a complex spreadsheet. It is a simple exercise that will fundamentally change how you view your portfolio. Here is the 5-step blueprint to calculating the true earning power of the businesses you own. Step 1. Open a notebook or a simple spreadsheet. In the first column, list every individual stock you own. In the second column, write down the number of shares you own for each stock. Step 2. For each company on your list, you need to find one key piece of data: its most recent annual earnings per share, or EPS. You can find this easily on any major financial news website like Yahoo Finance or by looking at the company's annual report. Make sure you are using the diluted EPS from continuing operations for the full fiscal year, often labeled TTM for trailing 12 months. Write this number down in a third column next to each company. Step 3. Now comes the crucial calculation. For each company, multiply the number of shares you own, from column 2, by its earnings per share, from column 3. The result is your personal share of that company's total annual profit. This is your look-through earnings for that single company. Write this number in a fourth column. For example, if you own 50 shares of a company and its annual EPS is $10, your look-through earnings from that business are $500 for the year. This is the amount of money the company earned on your behalf. Step 4. Sum the figures in the fourth column for your entire portfolio. This final number is the total look-through earnings of your entire portfolio. This number represents the total, underlying annual profit being generated by the collection of businesses you have chosen to own. This is the true economic engine of your investments. Step 5. Now, for the moment of truth. Go to your brokerage statement and find the total amount of dividends you received from your portfolio over the same 12-month period. Write this number down below your total look-through earnings. You will almost certainly see a massive gap. You might have received $5,000 in dividends, but your look-through earnings calculator might show that your share of the profits was actually $25,000. That missing $20,000 is not gone. It is the amount of money that the management teams of the companies you own have retained and are reinvesting on your behalf. This simple exercise will change your entire perspective. You will stop seeing your portfolio as a collection of tickers that pay you a small dividend. You will start seeing it as an ownership stake in a diversified enterprise that is generating a substantial and hopefully growing stream of profits for you year after year. It reveals the true hidden earning power of your asset allocation, allowing you to make executive decisions about your capital based on economic reality, not the dividend illusion. The opposite of a concentrated, high-conviction, look-through portfolio is the path taken by the vast majority of well-intentioned but misguided retail investors. This is the path of diversification. The term, coined by legendary investor Peter Lynch, describes the practice of excessive diversification to the point where it actually harms returns. The diversification investor operates under the flawed belief that safety comes from owning a little bit of everything. They are terrified of the risk of owning just a few stocks. So, they buy dozens, sometimes hundreds of different stocks, mutual funds, and ETFs. Their portfolio is a sprawling, incoherent mess. They might own a great technology company right alongside its failing competitor. They might own a high-growth healthcare innovator and a stagnant, dying industrial conglomerate. They have no clear investment thesis. Their strategy is simply to own the market. The fundamental problem with this approach is that they have no idea what they truly own. If you were to ask them to calculate their portfolio's look-through earnings, they wouldn't even know where to begin. They have outsourced their thinking to the market average. They own the good, along with the bad, the brilliant capital allocators along with the destroyers of capital, the wealth compounding machines with the leaky buckets. The inevitable result of this strategy is mediocrity. A diversified portfolio will, by definition, produce average index-like returns. But it's actually worse than that. After subtracting the management fees from all the mutual funds and ETFs they own, and the transaction costs from their constant tinkering, their net return will almost certainly be below the market average. They have mistaken activity for security. They feel safe because their portfolio is spread so thin, but in reality, they have simply guaranteed that they will never achieve exceptional results. They have diversified away any chance of building true wealth. This stands in stark contrast to the look-through portfolio. The intelligent investor understands that true risk management does not come from owning hundreds of stocks. It comes from deeply understanding a handful of truly superior businesses. Their risk is reduced not by the number of holdings, but by the quality of those holdings and the price they paid for them. Buffett himself has said that wide diversification is only required when investors do not understand what they are doing. By concentrating your capital in a small number of companies that you have rigorously analyzed using models like the Toll Bridge Blueprint and the private buyer test, you are not taking on more risk. You are taking on more informed risk. You are making a calculated bet on excellence rather than a hopeful bet on mediocrity. The diversification portfolio is the ultimate admission of defeat. It is the investor saying, "I don't know how to identify great businesses, so I'll just own them all." The look-through portfolio is a declaration of confidence. It is the investor saying, "I have done the work, and these 5 to 10 businesses are the finest economic engines in the world, and I am proud to be their long-term owner." The direct financial connection of building a look-through portfolio is the generation of alpha. In the world of wealth management, alpha is the holy grail. It is the measure of an investment strategy's ability to beat the market, or its benchmark. If the S&P 500 returns 10% in a year and your portfolio returns 15%, you have generated 5% of alpha. A negative alpha means you underperform the market. The vast majority of professional and retail investors fail to generate any alpha over the long term. The look-through earnings philosophy is a direct, logical roadmap to generating sustainable alpha. Here is how it works. A broad market index like the S&P 500 is by definition a mix of the great, the good, the average, and the terrible. For every brilliant, high ROIC compounder in the index, there are dozens of mediocre, low-return businesses. The overall earnings yield of the S&P 500, its total earnings divided by its total market value, might be, for example, 5%. By meticulously building a concentrated portfolio of only the most superior businesses, those with the highest return on capital, the longest reinvestment runways, and the most skilled management, you are creating a portfolio whose underlying earnings yield is structurally higher than the market average. Your hand-picked collection of businesses might have a weighted average look-through earnings yield of 8% or 10%. Because stock prices ultimately follow earnings over the long run, a portfolio with a higher underlying earnings yield is mathematically destined to outperform a portfolio with a lower one. You are not trying to outsmart the market's daily whims. You are simply owning a collection of businesses that is, on average, of a much higher quality than the market's collection of businesses. This is how you tilt the odds dramatically in your favor. It is the bridge from being a passive retail investor, destined for average results, to becoming an intelligent investor capable of generating market-beating returns. Concentration is the engine of this outperformance. By making larger bets on your best ideas, the companies you understand most deeply and that have the most powerful economic characteristics, you allow their superior performance to have a meaningful impact on your total portfolio. The diversified investor who has 1% of their portfolio in a huge winner will barely feel the benefit. The concentrated look-through investor who has 15% of their portfolio in that same winner will see their wealth transformed. This is not about reckless gambling. It's about the courage of your convictions, convictions that are built on a foundation of deep business analysis and the powerful logic of look-through earnings. This is the ultimate financial advantage. Building a portfolio whose economic reality is so superior to the market average that its outperformance becomes not a matter of chance, but of near inevitability over the long term. This is how you create true, lasting capital gains and beat the S&P 500. You have made it to the end. And by doing so, you have invested something far more valuable than money. You have invested your time and your attention. And in return, you have acquired a powerful new piece of mental hardware. You have learned to see through the noise of the market. You no longer see a flickering stock ticker. You see your proportional share of a real company's profits. You no longer chase the seductive but often misleading siren song of a high dividend. You now hunt for the true source of wealth, the compounding engine of retained earnings, intelligently reinvested. You have learned to think like an owner, not a renter, and that single shift in perspective will protect you from the market's manic emotions and the devastating costs of taxes and trading. You now possess a tool that the 99% of market participants will never have. But mastering the concept of look-through earnings is only the first half of the equation. Knowing what a business earns for you is the critical first step. It allows you to identify the truly wonderful businesses, the compounding machines that are worthy of your capital. But there is a second, equally important question that must be answered before you can invest a single dollar. What is that stream of future earnings actually worth today? How do you translate those look-through earnings into a concrete, rational price that you should be willing to pay? Identifying a great business is not the same as making a great investment. Even the best company in the world, if bought at too high a price, will result in a poor return. To solve this, Warren Buffett developed another, equally powerful mental model. It's the tool he uses to calculate the intrinsic value of any business, the tool that tells him the exact price at which he is willing to buy. It's the crucial link that connects the identification of a great asset with the discipline of acquiring it at a price that virtually guarantees a profit. The video that is now on your screen is the missing link. It is the other half of the map. It takes the what of look-through earnings and connects it to the how much of intrinsic value calculation. It is the bridge between identifying a great business and buying it at a price that ensures a margin of safety. You have already proven that you are not a typical investor. The fact that you have engaged with this material for this long places you in a very small minority of people who are truly committed to mastering their financial destiny. You think like an owner. But owners don't just identify wonderful assets, they are disciplined in the price they pay to acquire them. Your journey is not complete. Complete your mental arsenal. Master the art of valuation. Click on the video on your screen and learn how to value the earnings you have just learned how to see.